perhaps a good place to start would be with the Nagel commentary that's come through overnight. I mean, no surprise, he is known to be one of the more hawkish members of the ECB, and he's saying we need to wait until September to cut. The market is 21 basis points priced in for June. Is your expectation that the ECB go in June?
Look, it's not a surprise that Germany would actually be more hawkish, given basically their historical inflation stance. I think what we're into right now in terms of the stage is basically every central bank wants to be assured the next step is the right step. It isn't a situation where they want to go full blast and cut. But there's nothing really pressing them to actually go the reverse way in terms of how they've hiked over the past few months or the past few quarters. The position right now, I think, is more about wait and see. Let's see the data prints. Let's actually have a compelling case. And I think Germany will always have the same position in relative terms of inflation. Obviously, inflation is softening, but not at a pace that actually mandates an immediate response.
Yeah, I mean, their case is a bit different because the economy is so weak from a growth perspective. But, you know, one of the themes that has come up the last couple of months is one of central bank divergence. And it appears as though more and more central banks are willing to just get going with their rate cutting cycle and are no longer willing to wait for the Fed. That is interesting, but how does that also create opportunities in this space?
Here we are again, basically looking at the situation where we do have different paradigms. We have the U.S. paradigm, we have the European paradigm, we have the Asian paradigm. Obviously, we saw Japan exit zero or negative rates in terms of pushing us back over the zero line. We're looking basically at a situation where you have different concerns. One, in Europe, obviously, the war in Ukraine actually created quite a bit of stress in terms of the overall economic picture. On the other side, the U.S., actually, they've been surprised. The Fed, by no measure, has been surprised. I mean, they've backtracked on a few points of view. So you do see divergence. But the main theme, I think, is looking at global central banks is where is the best next play? So I think right now we have a division, yes. Obviously, we can see one cut from the Bank of England, one cut from the ECB this year. One cut was not priced into the Fed. Actually, it was 2 or 3 cuts when we began the year. Right now, we're hoping for one cut, if not even a hike, if the data comes in more aggressive. It isn't just one print we're looking at. We're looking at 3, 4 prints before actually we see the Fed act. So I think what we're seeing now is the beginning of a divergence, as you said again, and the ECB will probably will act before the Fed. The Fed won't act until we see a bit more color. So that gives us a bit more time in terms of equity markets. In terms of the U.S., we're still seeing quite a bit of push in U.S. equity markets because the paradigm has shifted. We're no longer looking at financials, or we're looking at an AI paradigm, where basically everything which has a beta to AI is actually rallying and carrying us through. So and that basically is the biggest market right now is the U.S.
Yeah. I mean, so ultimately what's happening is that the AI hype is driving this market higher and less so about Fed rate cut expectations. On Fed rate cuts, how likely is it that they perhaps decide to change what they're planning on doing depending on the timing going into the U.S. elections? Is that going to influence how the Fed decides on cutting rates?
That's really the key maker here is will Powell bend into elections if the data actually is poor? The data right now, he has 2 key points really, right? He has unemployment and inflation. Inflation is moving as fast as it'd like to do. The consumer is definitely slowing down. Unemployment is not rising at a level which is alarming at this stage. So there is really no catalyst for the Fed to actually act a bit more aggressively. And in fact, their expectations were probably a bit more aggressive in terms of cutting due to concerns about unemployment or inflation dropping. So I think we're more likely to see the Fed stand back, watch 2 more prints before they actually commit once again. They made the mistake early on in 2024 where they've given forward guidance. I think they're more likely to be a bit more conservative because what we're seeing again is market forward guidance. The market expects cuts, so now we're stuck in this phase where the market is looking at forward guidance. Now we've shifted it to, well, let's hold on for a bit longer until we see a bit more convincing data. So the forward guidance function now is a bit shifting back and forth. It's not as important as it was before, but the market is still buying into that forward guidance.
So I was looking at a chart earlier on the show today and wearing an old hat that you used to wear a long time ago, back when you were on the sales side. Cross-asset volatility, it just seems to be dropping and dropping and dropping. We talk about the VIX, interest rate volatility, FX volatility. Why is that the case? Why are implied options trading at such low volatility levels?
So let's just step back for a second. We've had 2 geopolitical events over the past 2 years of significance. We have Middle East, we've had Ukraine and Russia. There is really, we're coming out of COVID, right, over the past 4 years. we haven't had events affect us in the way that we thought they would affect us. And primarily, vol is bought when you have expectations of a paradigm shift. Right now, we see nothing in the short term. You have this amazing rally in equities driven by AI or technology. Market has not responded to rate hikes in the way we thought they would respond. Discounting hasn't really been the key driver. What we're looking basically at right now is a trend, a continuous trend of buying assets because money is cheap. Liquidity in the market is immense. Despite rates being where they are, the amount of liquidity with the financials is tremendous. Allocation is tremendous. People have left to allocate a tremendous amount of assets. So what we're seeing is a step back, especially given the summer month we're going into, plus the election cycle coming on. There's really not many people taking a swing at a change in the overall trend.